video, I'll be showing you on how you can trade volatility indices and be profitable. Okay, so I'll be showing you 4 ways on how you can trade them and be profitable. So let's start the video. Before I start, I just want to tell you guys that if you want to join our group, the link is in the description box. Okay, many people have been joining, and for those who have been reviewing good reviews about us, okay, I say thank you for all the good reviews. Okay, and we hope for more profitable wins. Okay, so the first way you can trade volatility indices is by swing trading, okay, using exponential moving average 21. Okay, so I made a video last time on how you can use this strategy. So if you have not watched that video, I can put the link in the description so you can go watch it, or it might show in the top right corner here. So I'll be showing you, or let me just explain or emphasize more on what I said the last time. Okay, so the way you can use this exponential moving average 21 is, okay, let's say price moved like this. Okay, so and we're plotting our moving average 21. Okay, so what this moving average 21 will do for us is that it will identify key levels on where market can continue the trend. If market is going in an uptrend, okay, market cannot just go like this. Okay, so market will come down, make some draw downs, then continue the trend. So what this moving average will do for us is that it will just identify key levels where, okay, market is in an uptrend, so to identify us where market is likely to continue the upward move. Okay, so let me be showing you guys some example. Okay, so right here, this is volatility 100, and as I used to say earlier on, as I said in the last video, you can't use this type of strategy, okay, without knowing the trend. So first of all, you have to know the trend of the market, and in my last video I explained that you can use 200 moving average to know the trend of the market. Okay, so what you are seeing in our charts, the red line is representing moving average 21, and the blue line is representing moving average 200. Okay, so what we are going to do now is that, first of all, we know that this market is in an uptrend because price is above this blue moving average, and it's showing that, okay, price is an uptrend, so we should look to buy only. So first of all, you know the trend. Second of all, if you've identified the touch, I'll not be explaining more of this strategy because I've done a video on this. So I won't just want to waste time explaining again, so just pick out the key things to note. So I'll advise, if you know what the video, you check it out. Okay, so we'll wait for the touches on the exponential moving average 21 to know that, okay, market is, so when there's touch in this red moving average, we tend to take our buy. Okay, and in the last video I added one more moving average, okay, to know when to buy and when to not to buy. Okay, so I'm very sure by now those that watch the video will have understood that this is actually unbiased. Like, it might consolidate a bit, okay, because normally if I purposely did not add the moving average because I don't want it to confuse most of you guys. Okay, so please, you cannot understand this if you don't watch the video. I think the video is about 30 minutes long, so I explained all you need to know on how to use this strategy. So if you've not watched it, I would advise you go watch it now. Okay, please watch it. Okay, so let's move on. This is another setup. You can see we have confirmed that market is actually in an uptrend, and you can see price moved and touch our red moving average, confirming that okay, this buy is validated. I can see you can see this 4-hour chart, and you can see from here. Let me show you guys. See where it's spot from here. You can see the number of buy, the number of candle, and this 4-hour chart about 8 hours. And I told you guys in previous video, don't be greedy. Okay, just close when you're satisfied. Okay, another setup here. I told you guys that you can also use this with candlestick pattern formation. Okay, an hammer was formed here and very close to touch this exponential moving average, and with our blue line it confirmed that this is an uptrend, so we're looking to buy. So when an hammer was formed here, you can see the buy. So this strategy is very simple yet effective, and I feel that it will come nicely for you. Okay, so the second, okay, this is the third actually. So in this, okay, with this you should know that this is not validated, as you can see that market I forgot to add the black moving average. If you see the moving average not smooth, if you see it like tangled like this, we leave the market, we don't enter. Is if it's coming down smoothly, okay, that's when we enter for either buy or sell. So like I said, go watch the video if you not watch it. Okay, so the second way, or the second setup on how you can trade volatility indices is by using trend line. Okay, so trend line does as dynamic support and resistance. Okay, so let's say markets move like this. Okay, so we can now plot our trend line, confirming that okay, market is in a consolidation phase. So with the act of our trend line, when market touches highest 2 to 3 touches on the trend line, we can confirm that okay, market is in a consolidation. So it's either we trade the consolidation or we trade the breakout. Okay, so you can see the first touch, second touch, third touch here. If our market is coming, it's likely that it's reverse. So we can either enter here, put our stop loss below the last market structure, then we can put our TP here, or it's possible market can come here, consolidate a bit, then make a breakout either to the downside or to the upside. So anyhow, so let me show you with market example. So you can see here that market consolidated a bit, then came out, retested, they made a nice sale. So I didn't put this upper trend line because in this type of market we are looking, if we are looking to break out, okay, for a breakout we don't need to put the two trend line. Okay, you can just put one to where you know that market can possibly reverse. So let me show you, let me explain again. You can see that, so what happened here was that a consolidation happened, and as you can see, when market broke, you can see this trend line. I put double trend line because for sometimes I use, for people that know me, and you know, in the group, in the Telegram group where I give as an analysis, you should know that for my support and resistance I make it a zone. Okay, because for me I see markets, I see support and resistance as a zone, not just a line. Okay, so you can't just say this is a line. When markets, you know, there can be consolidation below the line, so that's why I use support and resistance as a zone where market can possibly reverse. So that's what made me put the double trend line. And as you can see, let me just extract this thing. Yeah, so this was really happened. Okay, so you see a consolidation. Yeah, when market broke it, it came to retest it, then make a sell. So let me now explain with the market. You can see that when price broke it around here, aggressive traders will have entered the market around here, and you can see the drawback coming to retest. So that's why for every setup, for every strategy, there's advantage and disadvantages. Okay, the advantage is that if you are to enter trade immediately, price breakout of a either a trend line, okay, the advantage is that you can catch the early move of the market, and the disadvantage that if price is coming to retest the zone or the trend line, you don't know where to set your stop loss. So for me now, I trade. If you want to trade it, I use retests. Okay, so that's the type of, we have different type of traders. So that's how I trade. Okay, and as this YouTube, I won't be saying that much of, if you get it. So price broke it, came to retest, then make a sell. Okay, although price can also make fake breakout actually, but that's not for this video. Let me show you another example now. So with this example, you should see that you should have if I were the one, I would have drawn trend line here, okay, to show that okay, market is in a consolidation phase. Is either I trade the consolidation or I avoid it. But if I were the one, I would have avoided this type of trade, because first of all, if I plotted my 200 moving average, my 200 moving average should be like this. So it should be confirming that this is an uptrend. So you should be looking to buy. So if you have to trade consolidation, you should be looking to buy in this setup, in this type of trade. So I won't be selling, because this sellers will be weak in this type of market. So if you are wondering what I put here, if you are in the Telegram channel, you should have known that I said this on my analysis chart. Okay, this is an Equidistance channel, so I use it as support as trend line too. But this, it kind of make the consolidation like a zone, so that will be, because if I plot trend line, my trend line can either be like this or like this, and it won't follow the normal movement. Okay, so what I use this equidistant channel for is that to just capture the move, and I'll let the consolidation be in a zone. So I'll be making a video on how to trade, how to set equidistant channel in your chart right now. To add equidistant channel to the chart, you switch to first tap your screen, go to this shape button, then click add the plus sign, then you move down, go to channels, then go to equidistant channel. You do this, then plot your equidistant. Although this is not a perfect equidistant channel, but just to give you a glance through on how I set equidistant channel on my chart. Okay, so if you are setting for the first time, everything will not be closed like this. So if it's not enclosed, you go to, when you hold it, move to this edit button, go down, make sure this fill is checked. When the fill is checked, then it should fill, so you can set the color you want it to fill. But I think red is the default actually, so it will be filled like this, then you are good to go. Okay, so these are under setup as well. As you can see from our trend line, so what I'm trying to say, that if you spot consolidation, you set your trend line, you can see market consolidated, then broke out. Okay, so let me now show you another example. If you have to trade the retest of this trend line, you can see that there was no retest on the trend line until after year. So you can see the number of move you've missed. Okay, so I said everything have advantage and disadvantages. So if you are a type of seller, that if you are a type of trader that just enter the market, immediately price move out of the structure, then good for you. You are the type of trader that wait for retest, good for you. Okay, so the next way on how you can trade volatility indices is by using divergence. So here's clearly what divergence means. Let's say these are our screen right here. So first of all, for divergence, I use we can use divergence in different ways. Or what I'm trying to say is that there are different indicators you can use divergence for. Although for me, I don't cheat what I don't use. Okay, so for me, I use either RSI or MACD. Okay, so this is your price and this is your indicator, either RSI or MACD. I'll be explaining later, but let's want to understand the move. So divergence is simply connecting highs or lows of market. So let's say the price, you connect the highs of the price and the indicator, and they are showing different move, whereby the price is moving upward and the indicator is moving downward. Then that's when you see that okay, divergence has occurred. So let me show you an example. So you can see here that, take a look at this side. So you can see that with our divergence, price and indicator are moving different direction, where this one is going upward, this one is going downward. Okay, so if you don't have knowledge on divergence, okay, divergence is not something important that every trader must have. But if you're a type of trader that look for confirmation, okay, you can confirm your trade in different way. And if you're just learning it, kudos to you. So you can learn about divergence too. So how I use divergence, I see people using RSI and MACD for strategy. I don't use that, like divergence strategy, I mean. So for settings, okay, for my RSI, the last analysis I gave on, that was on the currency PS. Actually, my RSI was on 7. Okay, RSI 7. Okay, so for divergence, people use default settings, RSI 14, that's the default. But for me, I use RSI 7. So anyhow you use it, it works the same, although they look different, but at least they perform the same function. Okay, and for MACD, I use the same settings for MACD also. So you should, if you are new to divergence, it's not a must to learn it. And if you want to learn it to confirm your trade, then you can suggest in the comment section. I should make a video, everything about divergence, on how I trade divergence, and I can make a video on that. Okay, so another thing you should know about divergence is that you should not use divergence as a strategy. Use it for only confirmation. Let's say you saw like this now. As you can see, although this is not a clear one, okay, but I just use this one to spot it out. Let's say your trend line, okay, so you can just connect the lows of this market, and if you see your indicator doing otherwise, going downward, your price upward, if you connect the two lows of this and you connected the lows of the RSI, okay, and you saw that price came to retest this trend line, you should say that okay, at least I have a backup that is confirming my trade to be 90% sure that this market will buy or sell. Okay, so please and please don't use RSI or MACD as strategy. Use it as confirmation of your trade. Okay, so the last but not the least way you can trade volatility indices is by using indicators. Okay, by using indicators, I mean indicators that you use on 1 minute time frame or 5 minute time frame, those type of indicators. Some people, the one you learnt, the one you formed, you can just, if in case you learnt new way of trading volatility, or you learn from someone how to trade volatility on 1 minute time frame, okay, you can use that to trade. So I just want to tell you guys things to know when trading volatility on 1 minute time frame or 5 minute time frame. So when trading volatility on those time frame, I will advise that you should first switch to 1 hour time frame, 4 hour time frame, daily time frame, to first know the bigger picture or what market is really doing before entering on the 1 minute time frame. Okay, so try to know direction of the market, either uptrend or downtrend. Okay, so try to know that. You can use different ways you can just to analyze, okay. But the number one thing I want you guys to know is that even if you can know the direction of the trend, I will advise that if you can even know only that one alone, learn about it, know the direction of the trend, then you can switch to 1 minute time frame or 5 minute time frame to trade your entry, your strategy. So this doesn't apply to only volatility. It works for all indices that financial, boom and crash, currency pairs. First know the um direction of the trend, okay, and you are good to go. And you can confirm your entries using divergence, candlestick pattern, trend line, okay. So what I'm trying to say that on your 1 minute time frame, 5 minute time frame, I see people also using divergence to confirm trade on those little time frame. Although I've not used it, but I, s- I'm very sure that I used to see people using it. Not YouTube, I mean people that I know, okay, and it works for them. Okay, so with all this, I'm very sure that you have learned um a lot from this video.